Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our new IFRS 17 webcast. In this webcast, I will give you the highlights from the Deloitte comment letter that we sent to the International Accounting Standards Board on the 25th of September 2019, commenting on their exposure draft, proposing a number of amendments to IFRS 17. The webcast agenda will be structured around three items. The first one, I will give you the key observations which we have included in the cover letter of our comment letter. Then I will give you more details about the positions we set out in that comment letter. And finally, I will take a couple of minutes to tell you my view on the next steps from the end of the comment period. The key observations we put in the front letter are that we are generally supportive of the proposals in the ED, but we have recommended a number of improvements to the proposals. The first one that is particularly key for us is the definition of investment return services using a principle-based approach that is grounded on existing concepts within IFRS 17. The second key consideration is that we believe that the scope of the proposed amendment to account for insurance contracts held in order to recover of losses on underlying insurance contracts should be extended to all types of reinsurance contracts held. As for the application of the risk mitigation option to reinsurance contracts held, we think a better solution could be achieved by extending the scope of the variable fee approach to include reinsurance contracts held. We note that there is extensive discussion on the accounting for contracts with mutualisation features. And although this is not a topic exposed in the document, the guidance in IFRS 17 on the accounting for the adjustments to CSM from the changes in fulfillment cash flows arising from these contracts could be improved, and we said that much. Moving then into the more detailed discussion of these key considerations, in terms of the CSM attributable to investment return service and investment-related services, we support the ISB proposal to address what we believe is an appropriate assessment that there was lack of guidance on how to determine the coverage units that are related to investment services. Our concern is that some of the concerns raised by the TRG participants, indicating that several insurers are struggling with implementation of the CSM allocation requirements in IFRS 17, are only partially addressed by this amendment. To achieve the full benefit of the intended amendment, we believe that a consistent application will be achieved better if a principle-based approach is used to define the term investment return services. Our proposal is to use existing principles expressed in paragraph B75 of IFRS 17 as the basis for a new definition which we believe to be principle-based, effectively using an existing requirement calling for measurement of the time value of money in a particular way when the cash flows of the contract are asset dependent, irrespective of whether or not the contract meets the definition that would then require the accounting under the variable fee approach. With regards to the proposed amendments for the accounting of reinsurance contracts held in terms of the recovery of losses on underlying insurance contracts, we observe that the ISB has made amendments but introduced a qualification on the extent these amendments will apply when the loss from the underlying contracts arises at their initial recognition date. And that is that only the credit from reinsurance contracts held that offer proportionate coverage can be recognized in profit or loss. We are supportive of the proposal to reflect the benefits of the coverage provided by those reinsurance contracts. However, we do not think that the proposed amendment goes far enough. We are concerned that there is an inconsistency, a conceptual inconsistency between the underlying contracts losses that are reinsured arising at initial recognition of the underlying contracts and the same losses if they were arising in subsequent measurement. We believe that their insurance credits should be accounted for in both instances in the same way. And we would recommend that the restriction coming from the introduction of the proportional coverage definition is actually removed, the definition becoming then a redundant concept in the future IFRS 17 text. In that way, we can see that the existing measurement model can be applied in a new amended framework defined by IFRS 17 exposure draft, introducing then a better alignment of the accounting requirements to the economic reality. We take the opportunity of responding to this particular amendment to suggest also another improvement of IFRS 17 related to the requirement of IFRS 17 paragraph 63 and the application of the principle of contract boundary to reinsurance contracts. We agree with the ISB that future cash flows from contracts that are reinsured but yet to be issued by the cedent should be included, and the CSM calculated as a result of that. However, we believe that leaving the IFRS 17 CSM accounting requirements as they are will create amounts in P&L and in the balance sheet of the cedent that are not useful to investors. In particular, the difference between the initial locked-in discount rate and the discount rate applied to the fulfillment cash flows for these yet to be issued and reinsured contracts creates an insurance finance income or expense item that is not useful to investors, and it doesn't represent an economic reality. What we're proposing instead is that for that portion of the CSM, the unlocking adjustment is calculated with a different discount rate, the same discount rate that comes out of the observation of the market discount rates at the reporting date, and that is used to measure the fulfillment cash flows. In that way, the cedent will have an equal and opposite adjustment to the CSM to the adjustments to the fulfillment cash flows, reporting no interest or income, no interest expense or income in the P&L from the insurance contracts held. Coming to the applicability of the risk mitigation option and the inclusion of the reinsurance contracts held as another possible hedging instrument, we say that whilst we do not disagree with the ISB proposal in trying to address stakeholder concern with regards to potential accounting mismatches created by the variable fee approach, we think a better solution is possible. We believe that extending the eligibility for the VFA to those reinsurance contracts held that are effectively used as hedging instruments would eliminate any accounting mismatch more effectively than the proposed solution, then that extend the risk mitigation option to those reinsurance contracts held. Extending the scope of the VFA to reinsurance contracts held would result in the application of consistent principles and criteria to all reinsurance contracts and would remove any optionality. We went as far as drafting a proposed amendment to paragraph B115 to IFRS 17 that explains how these recommendations could be implemented. And you can see that presented on the slide, quoted directly from our comment letter. Coming then to the fourth and final key consideration in our front cover letter, the mutualization contracts point. We have added an appendix that discusses the accounting for the CSM and changes in fulfillment cash flows for contracts described in paragraph B67 of IFRS 17. We note that a material proportion of issued contracts within the scope of IFRS 17 have cash flows that affect or are affected by cash flows of other insurance contracts, and therefore are subject to the guidance contained in paragraphs B67 to B71 to account for fulfillment cash flows and CSM. These are referred to as acknowledged in the basis for conclusions paragraph BC 171 as contracts having mutualization characteristics. Our concern is that we have observed that the existing guidance in IFRS 17 does not result in a consistent accounting treatment when the entity adjusts the CSM for the changes in fulfillment cash flows that relate to future services. The ISB could amend IFRS 17 to clarify that the entity adjusts the CSM at the level of a single combined risk-sharing portfolio. IFRS 17 could be clear that all groups will have their CSM amounts adjusted in proportion to the changes determined at the same level of aggregation as the conditions described in paragraph B67 and B68 of IFRS 17 would have determined to be. It goes without saying that we believe groups will still be necessary for the allocation of the CSM to insurance revenue and profit. To explain our proposal, we also produced an example that is extracted from previous papers submitted to the ISB. In this example, entity A is a simple contract, is effectively a pure risk contract, and the contract is issued to 10 groups of policyholders, all forming a single portfolio, paying a premium of currency units 1,000 each, and each sharing equally in the returns of the insurance contracts portfolio. The portfolio of insurance contracts is therefore a specified pool of underlying items, and the returns of this pool are derived from the performance of the insurance contracts themselves, that is, premiums, less claims, and any other cash flows related to those contracts. So in the table below, you see what happens. One group has a claim for 4,000 currency units. The other 9 groups don't have any claim. In total, the portfolio creates an underwriting profit of 6,000 currency units, which is then shared, 90% of it, back to the policyholders. So they all get 540 currency units each, and that makes a total of 5,400 for the portfolio. We believe that applying paragraph B68 in IFRS 17 makes it possible to interpret the words payments arising from terms of existing contracts to policyholders of other groups to include a group's share in the 100% of the losses and 100% of the premiums before attributing to the group its share of a fixed percentage of the net portfolio result. In this instance, less than 100%, and in fact 90%, as illustrated above. And that is the correct application of paragraph B112 in IFRS 17 to include in the variable fee of the entity's share of the amounts that are mutualized across the groups of the portfolio. As you can see from the table above, all groups will have the exact same CSM of 60 currency units, thus making it unnecessary to make the calculation of the unlocking of the CSM at the individual group level, and instead allowing the entity to calculate directly at the portfolio level the unlocking adjustment. I'd like now to give you some highlights on the other recommendations in the comment letter which are not quoted from our cover letter. The first one is the proposed amendment on the recovery of insurance acquisition cash flows, where we are supportive of the proposals in the AD that entities should allocate insurance acquisition cash flows to expected renewals of contracts. We agree with the ISB that the proposed accounting treatment would provide useful information to investors. However, we are concerned that the impairment test for the insurance acquisition cash flows asset described in paragraph B35B does not explicitly address whether it is necessary to take into account the time value of money. Further, we note that the current words in IFRS 17 paragraph 59A and the proposed words in the paragraph 28A allow expensing of insurance acquisition cash flows for entities applying the premium allocation approach when the groups of contracts have a coverage not exceeding 1 year. We believe there is inconsistency and ambiguity there, and we'd like to propose a clarification that rectifies it. In terms of the first concern, we believe that more precise guidance on the effect of the time value of money in the impairment test is important. In a moment, I'll show you a diagram that explains graphically our proposal. But before doing that, I'll explain the second recommendation, which is to amend the text of the proposed paragraph 28A to say an entity applying the PAA may recognize insurance acquisition cash flows as expenses applying paragraph 59A only when they are allocated to the group of insurance contracts in accordance with paragraph 28C. We also recommend reflecting a similar change in the text of paragraph 59A. So coming to the first of our recommendation, this diagram illustrates the two components of that recommendation. Let me explain briefly what you see on the slide. On the left-hand side, at the reporting date, T1, we have our pre-coverage asset. The facts and circumstances indicate the need to test it for impairment. Underneath that blue bar, you see the discount rate curve for the portfolio which contracts that will renew and generate the net cash inflows. On the right-hand side, in dark blue, at period T3 and T2, you have the net inflows that will be coming from the renewals. The first piece of guidance we're recommending is that those net inflows should be discounted using a discount rate curve contemporary to T2 and T3, the future time when the renewals will take place. And in those years, the entity may judge that the curve will be different. And you see below the two bars, the two illustrative curves applicable to T2 and T3. Once those curves are applied and the net inflows discounted is calculated, we have then the second part of the recommendation, which is to discount those future net inflows to the reporting date in order to determine whether or not we have an impairment. And that discounting will be done using the appropriate point in the yield curve at the reporting date T1 from the portfolio where the renewals are going to come from to calculate then the discounted amount that will make the total recoverable amount represented by the turquoise and light blue column at T1. In this instance, the recoverable amount is slightly higher than the asset, therefore no impairment is required. We then talk about the scope exclusions for credit card contracts and loan contracts that meet the definition of an insurance contract. Here, we are broadly supportive of the proposed exclusions from the scope of IFRS 17. Coming first on the loan contracts that transfer significant insurance risk, we are supportive because without the amendments, financial institutions that issue this contract will probably have a significant cost to implement IFRS 17 with very limited benefit being provided to their investors. On the credit card contracts that provide insurance coverage, we support the proposal. The credit card contracts that provide insurance coverage should be excluded from IFRS 17 for the reasons noted in the ED. We agree that IFRS 9 is capable of addressing both credit and insurance risk, but we believe that IFRS 15 would apply to other elements, such as obligations to render goods and non-insurance services bundled in some of the credit cards. We also know that credit cards is not a defined term, and credit cards, although they may be the most common example, are not the only arrangement for which this scope exclusion should apply to. We then comment on the effective date proposals, and here we agree with the deferral of both IFRS 17 effective dates and the delayed application of IFRS 9 for entities with significant insurance operations. We note that there will likely remain a challenging deadline for many preparers. We then comment on the presentation in the Statement of Financial Position and the proposal of the IASB to change the level of aggregation for presentation purposes in the balance sheet. We support this proposed amendment mainly for the reasons set out in the ED. We then comment on the modifications and reliefs for transition. The first one is the one on classification of contracts acquired in their settlement period. We support the proposal in the ED. However, we note that this exemption is applicable only on transition and only to the extent that the entity does not have reasonable and supportable information for the full retrospective approach, leaving as a result an inconsistent treatment for liabilities which are identical economically. On the risk mitigation for insurance contracts with direct participation features, we are supportive of the IASB's proposal for the reasons set out in the ED. And that effectively makes the application of the risk mitigation an option and a requirement that can apply to the current period after effective date and the comparative restated period in terms of the P&L. As far as the opening balance sheet of the comparative period, we agree with the IASB proposal and we support it as an innovative way of resolving to a significant extent the accounting mismatch on transition date that otherwise would most likely persist for a number of years after transition. Coming then to the minor amendments, we are supportive of most of the minor amendments, but in some cases we have proposed an alternative approach that we believe better reflects what the IASB intended, in our opinion, and also gives a fair reflection of the underlying economic substance, aligned with the principles of IFRS 17. The first of these amendments where we have an idea different from what was proposed by the IASB is the amendment to paragraph B123A that excludes changes from cash flows relating to loans to policyholders from revenue. We observed that if the IASB was defining investment components by using a symmetrical concept of the cash flows involved, that is, acknowledging that an investment component can be an asset or a liability, you would have avoided the amendment altogether. And in the same vein, we propose to define the investment component as a cash flow that are 100% certain of repayment and for which repayment is contingent only on the passage of time, as a better definition than the one proposed in the exposure draft. On the amendment that excludes changes relating to the time value of money and assumptions that relate to financial risk from changes in the carrying amount of the CSM, we propose that entities should be required to exclude from the CSM all differences between investment components expected to become payable in a period and actual payments made in the same period, and reflect that difference in insurance finance income or expense. To this end, we propose to delete paragraph B96C of IFRS 17. On the changes in the risk adjustment for non-financial risks, we propose to leave the existing text of IFRS 17 paragraph B96D and to clarify that the change in the risk adjustment relating to future service always adjust the CSM at the current rate. Finally, on the recognition of contracts within a group, we propose to amend paragraph 22 in the same way as it has been made for the amendment of IFRS 17 paragraph 28, thus avoiding the need to maintain open groups for forward-starting insurance contracts that are issued in the period where the first group has been created. Coming then to the end of my webcast, I would like to just give you a few observations on the next steps. Comment letters are now being sent to the IASB, and the IASB will consider those comments and begin the redeliberation phase after the 25th of September, where the comment period closed. The redeliberation will be an exercise which will be done in public to decide whether to proceed with the proposed amendments to IFRS 17. When that period and process is completed, the IASB will publish an amended IFRS 17 text, and the current technical plan of the IASB indicates to be at the latest middle of 2020. With that final observation, I just take you to the final page of the webcast and reminding you that I remain at your disposal, and you have my contact details on the page, as well as my colleagues around the world, and you can follow us in the social media channels or visiting our website dedicated to IFRS insurance at www.deloitte.com/I2II. And with that, for me, Francesco Nagari, Deloitte Global IFRS Insurance Leader, is thank you for your attention and goodbye for the next webcast.